today is policy costs. Now, there's a lot of banter back and forth between a fixed cost of whole life and a fluctuating cost of index universal life, or really universal life in general, and that you want a fixed cost versus a fluctuating cost, and guaranteed versus non-guaranteed. All these different confusing things that can confuse people. So I'm going to make it very clear. Do a side-by-side comparison between the same age person, same health, same same amount of death benefit, one's whole life and one's index universal life, and structuring it. In a previous video, I talked about using death benefit options A and B to be able to reduce your overall costs. This is going to show the actual numbers of an example, and we'll be able to talk about the net amount at risk and why the cost actually goes down even if the cost per thousand goes up, because all insurance costs are calculated off of a cost per thousand. So you open up an insurance policy and there's this big spreadsheet that shows each year, at least in a universal life or an index universal life does. Many whole life policies don't show this, but even though it's there, it's not shown, and we'll talk about this, right? So, but everything's a cost per thousand. That's where the insurance cost is generated. So as cost per thousand changes in a universal life policy or an indexed universal life, we're going to talk about that, okay? And so with that, I'm going to share here. I'm going to open this up, right? And we'll go ahead and get started and share this chart here. Okay, so once again, so this is a guy, a male, 50 years old. So most people are saying, hey, we don't want to do insurance at 50 because they're too old, right? Type of a thing. Well, this is just an example at 50 years old. I mean, there's many different examples that we can use here, right? There's many different examples. This is just one, right? And so anyway, so 50-year-old, 115,000 of insurance, right? And this is the cost. The orange line is a whole life policy, okay, and the fixed cost, the guaranteed cost, is this over here on the right, is this $3,000. You might not be able to see that very well. Maybe I'll zoom in, right, on here, catch up. Okay, that cost, the cost is $3,039. Okay, where first year cost in this index universal life is $1,416. So about half the cost is between these two initially. Okay, and then we can scale this down, and we'll point out some other things. But I want to come back to this chart here. Okay, so in essence, what a common myth about whole life is that it has a guaranteed insurance cost. It's never going to go up and never going to go down. That is actually true, but internally that's not necessarily true with the insurance company. Now, what you're seeing and what you're charged is consistent. What the insurance company needs and wants is not always consistent, and the internal cost actually follows the same curve, if not more, than this index universal life curve that we have here. The difference is that a whole life policy basically averages out that total fluctuating cost and comes up with one flat cost. And then when they pay you dividends, they're just paying you dividend. All a dividend really is a return of premium. Now, when I say this, I'm not saying this is bad. It's just what it is, right? You're just, in a whole life policy, you're getting a return of premium. So in essence, you've overpaid, and they're giving a portion of it back to you. Well, the amount up front, the amount that you've quote unquote overpaid, is significantly more than what you over quote unquote pay or don't pay enough on the back end, right? So it equals out. But what you see on your statements and whatnot is a set cost that's guaranteed, that doesn't go up, doesn't go down. Once again, underneath the surface, internally, it's a different story. So it's not that much different. So what a universal life policy says, hey, let's strip that away and let's just charge the cost that's really at risk, right? And make it a flexible premium. And so that you can have options of what premiums you can make. You can pay more, you can pay less at different times. Where with the whole life, because it's built on that guarantee and you're kind of prepaying up front for the back end increase, it's a set cost and it's kind of rigid. You don't, unless you do a paid up additions rider, that gives you some flexibility inside of a whole life, but the base amount, that's not flexible at all. Where inside of a universal life, there's a minimum and a maximum, and you can pay whatever you want within those minimum and maximums. Now, is it to your advantage to pay the minimum? Absolutely not. That doesn't help you or serve you. So don't ever set up a policy like that. But it's nice to know that you have options in this kind of a scenario, right? And so here we have if in the whole life policy, 3,000 is this starting point, and where only about 1,500 or really 1,400 is the starting point here. So it's about half as expensive. Then the way a lot of universal life products work, specifically index universal life, is that there's kind of a front end cost. So for the first 10 years or 15 years, depending on how the plan's structured. And so you can see how it's kind of high, and then all of a sudden it drops like a rock. Okay? It drops down, and then for a lot of years continues on, and then it slowly goes up, and then here it meets, and then it does. So the myth about the costs get more expensive on the back end, well, it's not really a myth. It is true, but in compared to what, right? If the costs go up, and we'll show here, it shows here, we'll zoom in so you can see it better. It shows here that so although the costs go up, what it shows here is that overall I still paid significantly more until I got to this point. Okay, because if I zoom in, if we look at this here, and I zoom in, let's get it right. Here, if I draw a line down here, we're looking at age 88. So from 50 to age 88, it took, what is that, 30, almost 40 years before my cost of this index universal life policy even matched the whole life policy in this case. Now granted, I'm not saying that whole life is bad or that you shouldn't do it. I think there's a place for it. I'm not a proponent that there's only one way to do it. I'm just showing you the numbers, okay? And the differences. Now, differences don't mean good or bad always. They're just different, right? Okay, so why is there this drop in cost? Well, in a previous video that in another video I'd ask you to check out, I talked about death benefit options A and B and how to utilize them together to reduce your costs. Well, this is showing you the numbers. That video will explain why and what it is. But here, I'll zoom in here. At age 65 here, he's going to stop contributing to the policy and let it fund itself. Well, if you switch from option B at age 65 to option A, you can see that the costs totally significantly change and drop, okay? And that's why, and it stays low for a lot of years, right? And then it slowly over time creeps back up, okay? To the point where at age 89 is the first year that the index universal life policy actually is more expensive than the whole life, okay? But think about all the years previous that you paid this $3,039 in your whole life policy when you were paying 50 to 75% less for decades of time in your index universal life policy, right? And then on top of that, with the index universal life, not only are you paying less insurance cost for the majority of the time, but if it's structured properly, but you're also able to accumulate more cash because more of your money's going in, assuming you paid the same premium to both policies, right? Assuming you paid the same $3,000-ish a year into the policy, both policies, you're going to have more cash in your index universal life because there's less cost. And then you add the index portion to it, the idea that it can get market-based return without the risk. Now you have an account value that is growing significantly, potentially better than this whole life policy, okay, in this case. Okay. And so, on to another video, I'll explain why this goes down, and this option A versus B, this net amount at risk kind of a thing, that even though the cost per thousand can go up, your actual cost can go down, type of a thing, and we'll make it happen. All right, I'm excited to see you again. Talk to you later.